Yes, I think Chairman Mao used to say, the future is bright. There will be some bumps along the way. Keep that in mind when you invest in these Chinese Fab 5.
Welcome back, friends, for one more update from the world of high-growth EV stocks. In case you are new to this channel, please do consider subscribing. Now let us get right into it. NIO reported their fourth quarter earnings last night, and it blew away almost all estimates by a big margin. Only on the EPS front they had a miss, but was later found out to be only due to the recent depreciations in USD against Chinese yuan. The streets were largely expecting a net loss of 7 cents per share, improving from the loss of 39 cents per share a year ago, while the revenue were expected to grow 148% to $1.01 billion. And in the actual results, NIO reported per share loss of 14 cents on revenue of a record $1.02 billion. Gross margin improved to a stunning 17.2% in Q4, from minus 8.9% a year ago, and 12.9% in Q3. Vehicle margin improved to 17.2% from minus 6% a year ago, and 14.5% in Q3. NIO's cash balance climbed to $6.5 billion at the end of the quarter, versus $3.3 billion in Q3. NIO had already disclosed that Q4 2020 deliveries had grown 111% to 17,353 vehicles. Sales, however, slowed slightly to 5,578 vehicles in February, from 7,225 vehicles in January, as most Chinese businesses shut down for a week during the Lunar New Year holiday. Q1 is generally a slow quarter for the auto industry, so this slight downfall in February was totally expected. Let us now look at something even more important that came out from the NIO management yesterday. Their outlook for the rest of 2021. NIO sees Q1 deliveries of 20,000 to 20,500 vehicles, up more than 421% from a year ago period, and up more than 15% from the Q4 which just got reported. Revenue is seen at $1.13 billion to $1.16 billion, up about 438% from a year ago period, and by about 12% from Q4. On a call with analysts, CEO William Li said production capacity had climbed to 10,000 vehicles a month in February, from 7,500 in January. However, in what might also be a crucial piece of information, he also warned a shortage in chips and batteries will force a slowdown back to 7,500 a month in Q2. This global shortage in chips is making headlines around the world right now, and is a problem for all major EV manufacturers. However, the good news is that it is only expected to be a temporary hurdle. The NIO management shared some more information, which we expect will be taken very positively into account once the current bear market settles down. NIO disclosed that the batteries won't be the only recurring revenue NIO generates. The company is also considering autonomous driving as a service. Customers will pay monthly fees to access its top autonomous driving software. Providing autonomous driving via a subscription is a new idea. Even Tesla charges a one-time fee for its full self-driving mode feature. Other auto executives will surely watch how NIO's rollout goes. Executives will also be watching NIO's overseas expansion. European expansion appears quite imminent, but the management said that a US expansion will require lots of patience. NIO bulls will be encouraged by what they heard Monday evening, but overall, short-term traders appear a little disappointed. NIO shares tanked by 10% on Tuesday, after having risen by 10% on Monday before the results came in. The crash is also being helped by the fact that broader markets are also in bear market territory at the moment. It needs to be mentioned that investors have extremely lofty expectations for NIO, and even good results can disappoint them. We would like to take this moment to also underline that the NIO stock has always fallen on the day after its last 4 earnings reports, but the shares have rebounded fast. It's quite inexplicable and somewhat ridiculous, but this has become the normal for NIO. Great quarterly results is always followed by a crash in the stock, and then that is followed by a fresh bull run. We would also like to take this opportunity to shout out to those of you subscribers of this channel, who truly understand the potential of NIO, and are holding NIO long and strong, even through disappointing red days like today.
Weigh in is China EV expert Michael Dunn, CEO of ZozoGo. Thanks for joining me today, Michael.
Thank you, Alyssa. Great to be here.
All right, so a lot of these China EV stocks are finally coming back down to earth a little bit after some meteoric moves, but their valuations remain pretty sky high and they're getting quite a bit of attention right now. So what do you think is behind this heightened interest as of late?
All right, let's step back for a moment and look at the big picture. We're in the midst of a once in 100 years transformation of the auto industry. And what do I mean by that? For most of the last century, the heart of the car was the engine, pistons and drivetrains and fuel and spark plugs. But what we're moving toward, and very quickly, is that the new heart of the car will be a computer, and the new gasoline of the car will be software. So why does that matter? Well, Tesla's pioneering this transformation, and the car is changing before our eyes, so that when investors look at new car companies, they start to ask themselves, are they the old type, engine-centered, or are they the new type, computer and software-centered? And with these Chinese firms, NIO, XPeng, and Li Auto, we definitely see them in the Tesla camp. And that explains the great valuations and the huge enthusiasm for these stocks.
Interesting. So would you say that those three stand out the most to you in terms of ones that are really going to start ramping up production and have that kind of edge in terms of technological innovation?
Yes, no question about it. XPeng, Li Auto, there's a few others, WM Motors, as well as NIO. They really are the ones out front. I call them part of the Fabulous Five, the Fab Five. And Michigan basketball fans will remember these guys from years ago. Very talented, very young, and very fragile. Keep in mind that about a year ago, NIO needed a bailout from a provincial government in China because as an electric vehicle startup, things are touch and go. They're not making money yet. And yet suddenly, when Tesla's stock started to soar earlier this year, investors said, oh, we're too late for the Tesla train. What other car can we jump on? And the names NIO, XPeng, and Li Auto really stand out in that regard.
Yeah. So where do you see the China EV market headed from here? Do you see any industry consolidation happening in the future? Or do you think we're set to see even more EV names, maybe lesser known ones that are behind the Fab Five that you mentioned cropping up and really trying to gain momentum there?
Well, as we know, there's hundreds, literally hundreds of EV makers. 95% of them you can set aside. They're not going to be relevant. They're going to go away. They're going to fail. They're going to go bankrupt. But because you need deep, deep pockets. And this is what NIO has. They're backed by Tencent. XPeng is backed by Alibaba. And Li Auto's founder is a billionaire in his own right. So they need the big bucks. They need the backing, and they need the government support. And when those are required, the field really narrows quickly. So 5 or 6 companies is all. Don't look for some other ones coming up quickly from behind. This is it.
All right. And then talking about the backing of the likes of Tencent and Alibaba and other US automakers looking to maybe grab a piece of the pie, do you see any sort of other partnerships or acquisitions on the horizon?
This is one thing that distinguishes the tech industry, tech-driven, software-driven, new generation of automakers from their cousins in the Chinese auto industry. So most traditional Chinese auto companies have partnered with global automakers, and GM and BMW and Toyota, they all have joint ventures in China with partnerships. But what's different with these tech companies is they're saying, you know what, electric, autonomous, connected vehicle technologies are so new, we don't need to partner with global automakers. We're already there. In fact, we could go ahead of them. We could leapfrog them. And as a result, in as much as the global automakers would like to partner with these Chinese companies, I don't think that's going to happen. Look for the Chinese to go alone and say, we can do this with our own brains and our own money.